Hello, this is Connie Belden, and we are at the very last video for Managerial Accounting. I hope you've enjoyed them as much as I have enjoyed making them, and that you've learned a lot in this course that you can carry forward into your future. Okay, let's take a look at, similar to problem 1423, where we're going to kind of combine several of the concepts that we have learned to date. Okay, assume that product A has a 5-year life. The machinery costs $340,000 with a 0 salvage value. Annual sales are $380,000. Annual variable costs are $170,000. Depreciation is $68,000 per year. But keep in mind that depreciation is a non-cash expense. It's a sunk cost. And fixed costs are $86,000 per year. Now, the company has a required rate of return of 22%. But their discount factor that we'll use on the tables will be 20%. That represents what we would call their cost of capital, or maybe what it would cost them to get a loan. Okay, so let's determine payback period. First of all, we would take the yearly sales revenue of $340,000. Oh, sorry, that's $380,000. We would subtract out the variable cost of $170,000 and the fixed cost of $86,000. Now notice I did not subtract out the depreciation of $68,000 because that's a non-cash expense. Okay, so then when I take $380 minus $170 minus $86, I get the net annual cash inflows of $124,000 per year. Now that's an equaling amount, so that makes it easier to calculate the payback. The cost of the equipment is $340,000. So if I take the cost of the equipment divided by the annual cash inflows of $124,000 per year, that means that the piece of equipment would be paid back in 2.74 years. Okay, part 2, let's take a look at net present value. Again, it's given to us the equipment is going to cost $340,000. So that will set us back $340,000 right now. Now remember in part 1, we came up with our annual cash inflows of $124,000 per year. That would actually be for years 1 through 5. Okay, because it's a 5-year life. So on the table, we want to look up 5 years, and we want to use the 20%. The 20% is the discount rate that they gave us. So I'm going to go to the annuity table because it's $124,000 per year. I am going to look up 5 years and 20%, and I get 2.991. Okay, so I will take 124,000 times 2.991, and that gives me 370,884. Okay, now when I add these together, negative 340 plus positive 370,844, I get a positive 30,884 as the net present value. Okay, next in part 3, they want you to calculate the IRR. We first have to determine the discount factor that we're going to look up on the table. And we'll do that by taking the investment of $340,000 divided by the annual cash inflows, which we calculated were $124,000. And we come up with a discount factor of 2.742. Okay, so now this is a 5-year life. So what we're going to do is go to the 5-year line on the annuity table and look for 2.742 or as close as possible, and then look up to see what percentage rate that is. Okay, so I'm going to go to the annuity table, look across the 5-year line, and again, I'm looking for 2.742. Okay, 2.742 is very close to 24% because 24% is 2.745. So as I look up, that's 24%. Okay, so therefore, as we look across and see that, our R is going to be 24%. And that's good. That is greater than our 22% required rate of return. Okay, next in part 4, we're going to calculate the profitability index. That is taken by doing the present value of the cash inflows. And that is calculated up here was $370,884. So we'll start with that. That was from part 2. And then divide it by the investment, the cost of the equipment, which was $340,000. Okay, so when you do that, you get a profitability index of 1.9, and that can be compared with profitability index of other options. And of course, you would want to choose the one with the highest profitability index. Okay, part 5, calculate the simple rate of return. Okay, as we calculated in part 1, the annual net cash inflows are $124,000. Okay, we were given that the depreciation per year right here is $68,000. So we didn't even have to calculate it in this case. So therefore, our annual incremental net operating income is $56,000. Now, to get the simple rate of return, I would take the $56,000 that I just calculated and divide it by the investment of $340,000, and that gives me 16.5%. Okay, and I'll make the spelling correction right there. I had an extra E. Okay, so that is lower than the 22% required return. So in part C, and we'll base it on the simple rate of return, should the product be accepted? No, the simple rate of return is lower at 16.5% than the required rate of return of 22%. And that completes our final video. Thank you very much. Again, I hope you've enjoyed managerial accounting, and best wishes on your future endeavors. Thank you very much.